Okay. So in this video we're going to go through a question and show you how to answer this by using only 2 points. It's a 25 mark question, but you can do 2 points or 3 points. No more than 3 is the big thing. And the question is, to what extent should a country be worried about a current account deficit? And in this case it's a persistent deficit. So I just wanted to show you the balances, the current account balances in the world. This is as a percentage of world GDP, that you've got surplus countries, obviously, and for every surplus, all those surpluses added up, there must be deficit countries to the same number. So the surplus countries are the oil exporters, and then some advanced economies like Japan, Germany, Netherlands, and China, and that's the one that we're going to look at in more detail, really. And their argument with the US, the trade wars between the US and China, because the US is a deficit country, so is the UK, and there's a few other emerging market countries as well. And in terms of the trade deficit with China, this is some data from this article here, which is an excellent article. I'd recommend that you watch that one. But you can see that these are the exports, okay, from America to China. Those are the imports, and the deficit has been very large and growing until Mr. Trump puts his tariffs on here, and so the deficit has improved slightly, okay? But that's the subject of another video, whether or not they were beneficial in the end to the American economy. But this is the trade deficit. Large US imports. Here the import computers, cell phones, apparel and footwear, and they export aircraft, soybeans and automobiles. And so I think really you can be arguing that this is where they have their comparative advantages, but I wanted to also show you that now China owns 15% of the US public debt. In other words, what's happened is, as China has earned the money from exporting to the US, and they're earning dollars, they've actually just been investing it back into America, into their fiscal deficit, and that's where they've been buying the debt that the US government have had to issue. So do not, please do not confuse the fiscal deficit and the current account deficit, but there is a sort of link that you would be well advised to think about, but never ever confuse the fiscal and the current account deficits. Nothing to do with each other. Okay. You need to know and be able to explain when you're answering the question, should we be worried? Because the second point we're going to say is, well, a deficit on one account, the current account, has to be financed, if you like, on the other account, the financial account. And so you need to be able to say that, trade in goods and services is on the current account. And if that's in a deficit, and then we come along and we add in any primary income that's been paid out or received in, that's when you get to the total of the current account. And the income here that we're talking about, primary income, is interest on the banking accounts, profit on direct investment, and dividends on portfolio investment. Okay, now that's the subject of another video, so that I'll explain that in more detail, but you need to bring this up in the essay just to be able to explain the funding problem. And yes, we should be worried because of the funding problem. Okay, there's also a bit of secondary income, remember. There's a capital account, very small, we hardly talk about it. And this is where we have our financial account. So this is where, if you've got a deficit on the current account, it has to be financed on the financial account. Funded or financed are good words to use, either by attracting some inward investment, multinationals, FDI, banking flows, hot money in the world economy, or portfolio. That's some people buying your stocks and shares. And to the extent that you haven't done that, then your official reserves as a country will fall. So if you've got a deficit on the current account, you have to finance it or fund it either by attracting investment or you're going to find your official reserves are going down. Now, the first concern that I would bring up is the concern that there's a negative impact on domestic output firms and jobs. So you'd be talking about that it's got a negative effect on AD. AD is CIG X minus M. If that's in the deficit, shifts AD to the left, lowers real output, slows economic growth. If it's an export problem, not an import problem, you can mention the negative multiplier effect. Employment is lower, unemployment is higher, living standards are going to be reduced, and you can talk about growing poverty. But plenty there to develop a good, strong analysis of, yes, we should be worried because of the effect on those things within the domestic economy. Okay, now evaluate that. Well, it might be that the imports we're buying means that our living standards have gone up because we can afford more goods and services. Depends on the type of the deficit. Is it short run, cyclical? So in an economic cycle, when there's booming away, then countries expect a deficit. But when there's a slowdown, it should then turn to a surplus, and over the cycle, it should sort of balance out. Is that what we're talking about? A short run cyclical problem, or a structural underlying persistent deficit? So you wouldn't necessarily use that in this essay, but in others you would bring that in. And what's the size of the deficit? Always worth little, snippets of evaluation coming through there. Because you're moving the AD to the left, you really need to talk about the elasticity of the AS curve and the extent of the output gap. Where do we start? Small output gap, lower AD, minimal effect really on real national output, bigger output gap, bigger effect on real national output. Okay, could bring in, if you wanted to, the classical model as well, but you're starting to really do a lot of evaluation at that point. I think a better one might be to say, well, because you're keeping it into current account deficit, well, you know that if you've got a surplus, a deficit on one country, then the other country's got a surplus. If they are growing because of their surplus, then that might mean that they buy more of your exports. Might not, but it might mean they buy your exports. And importantly, if it's been caused by an import of capital goods, then I would argue that that increases aggregate demand and aggregate supply. So there's an increase in the productive potential of your economy, so that you can basically argue that that's not such a bad thing. So living standards, possibly just food, goods that we want to buy, but capital goods. So it's about the type of goods that we're buying. Okay. And lastly, some argue that we shouldn't be worried at all because the exchange rate will fall. Okay, so as the exchange rate falls, it corrects the balance according to free market economists, but it will cause inflation to rise due to those higher import prices. So, lots of evaluation there, hopefully. Just found some articles for some application for you. US companies, it's saying here that US companies can't compete, and it says there's a decline in jobs of 35%, measured by the number of jobs, manufacturing jobs, 35% down. Okay, it has rebounded a little bit since the tariffs, but overall it's still 30% down. Okay, this comes from that really good article in The Balance, and it talks here about China can manufacture many goods at competitive prices, lower standards of living, lower wages, etc., and a sort of pegging. They call it a pegging. It's not quite a pegging, but they call it a pegging of the yuan to the dollar because, as I've just explained, what China have been doing is, when they have earned their dollars by selling to America, they're using those dollars to buy what they call treasuries, which is equivalent to the UK gilts. It's the issuing of bonds by the government to finance their fiscal deficit. And that has then meant that the demand for dollars has gone up, and so they've basically been keeping the dollar high and the yuan low. So that's the rhetoric coming out of the US anyway. But in a nutshell, nice little snippet here. The trade deficit has been caused by lower costs of labour and the fact that America are demanding the goods produced in China. So it is again about going back to comparative advantage and saying it's not, not such a big problem, because that is what comparative advantage is about. Okay, these are two articles coming up now. This one here from the Economic Policy Institute says that 2.4 million jobs have been lost. And this one here, which is coming from this balance, it talks here about, the US is an open market with low investment in infrastructure, and they're investing overseas, but they've got an overvalued currency. Then they're saying China, very closed still, lower costs, etc., and a managed undervalued currency. So again, just sort of pointing to what they say are the problems and the reasons for that. But they then mention 3.7 million jobs, and they mention that the normal adjustment mechanism, when a surplus country ought to have a rising exchange rate and a deficit country ought to have a falling exchange rate, that hasn't operated. It couldn't operate, and the yuan is essentially pegged. It's not official. Essentially, they say it's pegged to the dollar. Okay, that's why they talk about the yuan being manipulated, and it's an undervalued currency. Okay, second concern, it's got to be funded. A current account has to be funded. To the extent that it doesn't, you're going to run your official reserves down. So what's the problem with it being funded? Well, the problem is it may not get funded in the end, but the inflows on the financial account have to be paid for, in the sense that there then is a return to those investors. So it's very similar to borrowing. If you went out and spent more than you earned, then you have to borrow the money, but then you've got to pay interest on that. And so what happens is that the primary income accounts start to worsen, and they keep adding to the current account deficit on top of the current account deficit. So it's like debt is going to cause further debt, okay, when the interest is paid on it. So you've got to work your way through that and explain that to say that is the problem with the deficit, because you've got to borrow the money, and then that has to be, you're paying interest on that. It adds to the deficit. Okay, this is the UK. Just thought I'd show you this. These are the trading goods. This big area here, the green, deficit. Trading services, nice positives. But here, there's your primary income. And apart from a couple of quarters, we've had lots of negative primary income. And here you can see where that's come from. We're still actually earning more money, more income from our investments overseas, because that's positive on the direct investment, but it's the portfolio investment, the buying of shares, the dividends going out, that's this line here, that's been negative. So you can see overall the primary income account tends to be negative. There are periods when it's positive, and then it's going back to negative again here. So gives you a bit of information. What's that concern? Let's go on. It doesn't automatically happen. So just because I buy a car from China, for example, and China have got this money, they don't automatically have to invest that back into the UK. They could invest it in Sri Lanka, for example, and they've been doing that with the increase in the Silk Road. So something to look forward to. Therefore, in order to attract, and this is really quite important, in order to attract that investment, that countries have to raise interest rates. So to get the hot money flows into the banking sector, they might have to raise interest rates, which can reduce investment, reduce aggregate demand, reduce consumption, slowing down the economy. They may, to attract FDI, have to subsidize investment. That's sort of being talked about at the moment because of what's happening in America, and what they call the Inflation Reduction Act, where the Americans are subsidizing green production, but it's being argued that it's not actually about green production, it's just about getting more inward investment. And so UK and the European Union are talking about having to subsidize some investment into their countries, or cut the corporation tax. And both of those, subsidizing or cutting taxes, is going to have an effect on our fiscal position. Okay, FDI, big topic, we look at it later. It can impact the environment, use up scarce factors, and as I say, if we don't get that money, then you could actually find that the country is running out of reserves and has to call in the IMF, which is what the point of the IMF anyway. Okay. If, however, and this is important that we get to this because people are always saying, it means that we're borrowing money, we're attracting FDI and the outflows are going out. Well, yeah, but if a country has attracted FDI, foreign direct investment, into the country, it's got many advantages. It's got investment, multiplier effect, job creation, productive potential goes up, and there's a fiscal dividend when the taxes are paid and when incomes go up and they spend it, then income tax and VAT goes up. So there's a fiscal dividend, okay? If it was portfolio investment that has been coming in, then the value of shares will go up, and the value of shares makes everybody wealthier, so that increases wealth within the economy, which can stimulate spending. But it can also mean, quite importantly, that UK firms can use the fact that their shares have risen in value to then issue more shares. So people will want to buy those shares, and they issue more shares to fund investment. So this issuing shares to fund investment is another way of funding investment by the UK firms. And lastly, if there's this hot money coming in, then some people say that's great because it improves the liquidity in the banking sector. So we shouldn't worry too much, they say. And finally, a nice graphic, I hope, of everything that we've said. So the drawbacks, economic growth, the unemployment, the type of unemployment, might it be structural, etc., poverty, might have to call in the IMF, but then this is the increased level of debt. So these are the two big, should we be worried? Yes, we should, because growth goes down with all its consequences here. Yes, we should, because we've got to borrow lots of money with all the consequences there. And then the evaluation of that type of deficit, cause of deficit, how long, how big is it, etc. And also there are some benefits. Maybe we've been having that capital, and then these are the benefits here of the type of funding that's gone on. So hopefully that helps you, gives you a little bit of application, and you'll be able to write a really good extended essay with that analysis really well developed.